Hello investors, this is Lukasz Labedzki and this is Franklin Templeton Institute's Market Highlights. It's been a central banks week. Among the major central banks, we had the Fed, the Bank of England, and the European Central Bank. All of them held rates steady, but it would be a mistake to say that nothing has changed. There has been a significant shift since the war in the Middle East and the accompanying oil shock, which have put central banks in a challenging position where they need to balance inflationary pressures with risks to real growth. Let's start with the Fed. The Fed left interest rates unchanged as widely expected prior to the meeting. Its tone was fairly neutral, balancing the two goals of its mandate, which are the labor market and inflation. For now, the Fed seems to view the impacts of the Middle East conflict as largely short lived, not to use the word transitory. What can be seen as a delicate easing tilt is the fact that the Fed, in its dot plot, which is the expectations for the policy path by committee members, still shows one cut as their base case. Markets are less relaxed. They are more worried about inflationary pressures, and we have seen a significant repricing of policy rate expectations since the Middle East conflict intensified. As of now, the market expects virtually no cuts in 2026 and roughly two cuts in 2027. It is a material change versus the end of February, just over 2 weeks ago, when the market expected two cuts or even more in 2026 alone. Moving to Europe, where central banks are dealing with the same set of challenging circumstances. The Bank of England held rates steady, however, the meeting was interpreted as a hawkish one, with significant moves on the shorter end of the yield curve. But the chart we present here refers to the European Central Bank. The European Central Bank left rates at 2%, but it seems slightly less convinced that this is a good place. The tone of the meeting was rather balanced, with maybe a slight hawkish tilt, as upside risks to inflation given the Iran war were stressed. This was somewhat downplayed, though, by acknowledging that the European Central Bank focuses on medium term, not short term inflation. Again, markets are less sanguine. Markets now expect more than two hikes by the European Central Bank in 2026 alone and no action through 2027. A significant change versus late February, when steady rates with some dovish bias were expected. What makes European central banks different from the Fed is that the Fed has a two sided mandate, which gives it the comfort to balance both risks, while in Europe, central banks have a largely single sided mandate focused on inflation. Another factor is that the US economy is more resilient to energy shocks given that it is a net exporter. This is perhaps why the repricing of interest rate expectations has been somewhat more severe in Europe than in the United States. When we compare expected interest rates in the United States with those in the euro area, we get interest rate differentials, which are illustrated in this chart as a blue line. As you can see, they don't perfectly but fairly closely mimic the dollar euro exchange rate, the green line. What we can see is that the recent strength of the dollar is not explained by interest rate differentials, as those two lines have diverged despite some dollar weakening on Thursday. There are good reasons for this. We are in an environment of rising global risk premia and a terms of trade shock that puts pressure on the currencies of energy importers and supports the dollar. As long as uncertainty prevails, with no clear view on oil flowing back through the Strait of Hormuz, this is expected to continue. When the dust settles and the uncertainty is over, the market will likely start focusing more on economic fundamentals. Thanks very much for listening. Trade well, but most importantly, stay safe. Cheers.